GDP recovers in quarter 3 but FY target still far away. CEA Anant Nageshwaram says India's growth momentum is strong despite risks. India's economic growth engine showed some spark in the December quarter to recover from a low in September quarter, yet the 6.2% GDP growth reported was slowest since for quarter 4 of FY23, barring one quarter the previous one, quarter 2, when it was recorded 5.6% revised estimate. That leaves much to be done in the final quarter of the fiscal to achieve the full year revised growth target of 6.5% put out by the National Statistical Office on Friday. To be sure, even a 6.5% GDP growth for FY25 would be 270 basis points lower than the fiscal revised of 9.2%. Fiscal's 9.2%. The third quarter growth rate supported by government spending and consumption amid festive demand was still far from the 9.5% revised estimate recorded in the corresponding quarter of the previous fiscal. A Mint poll of 23 economists had predicted 6.3% growth for quarter 3. Meanwhile, gross value added, which measures the total value of goods and services produced in an economy, also grew at 6.2% in quarter 3. Tepid growth in manufacturing and mining impacted overall GDP growth in quarter 3 despite higher growth recorded by agriculture, electricity, construction and tertiary sectors. CEAs remained positive during the presentation following the release of the latest GDP data. While he noted that global economic uncertainty persists due to trade policies, inflation risk and market volatility, India's growth momentum remains strong. Nageshwaram said the factors like robust rural demand, recovering urban consumption, and favorable agricultural conditions should help stabilize food inflation. Additionally, in union budgets focus on agriculture, MSMEs, investment and export is expected to bolster India's medium-term economic prospects, he added. To be sure, India remains one of the world's fastest growing major economies. The government has made some revisions to key GDP data. Quarter 1 and quarter 2 GDP growth rate of FY25 have been revised to 6.5 and 5.6 from 6.7 to 5.4 respectively, and the real GDP growth rate for fiscal year FY24 was revised to 9.2% from the earlier estimate of 8.2%, while the FY23 growth rate was revised from 7.6 to 7.2%. Despite the sharp upward revisions to the last 2 years' GDP figures, FY25 figures appear to remain resilient, although led largely due to upward revisions to the second quarter figures. Some economists expect India's FY25 GDP growth to be lower than the RBI and NSO outlook because of the comparatively slow economic growth in the first 3 quarters of the fiscal year. We expect the FY25 GDP figure to be lower than CSO's estimate by around 20 to 30 basis points. We expect the FY GDP figures to be lower than CSO's by 20 to 30 basis points. Bear tramples bulls as global fears sent markets tumbling. On the day global stock indices were battered by rising international trade tensions induced by US President Donald Trump, Indian markets followed their slump, with all gauges dipping sharply. Japan's Nikkei and China's CSI fell 2.88 and 1.97% respectively. Almost on cue, the Indian benchmarks Nifty plunged 1.9% each to uh, Nifty and Sensex plunged 1.9% each.